This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Never a dull moment in crypto. We've seen prices over the last few days really fall off a cliff after holding a level close to $30,000 for quite some time. Bitcoin finally broke down and today is trading, in around $22,000. Most of the selling pressure, it seems, is coming from the bigger macro factors at play here. We're seeing the risk of an accelerated tightening schedule from the Federal Reserve, which is taking a lot of wind out of the sails of whatever risk assets had a bid for that brief little rally. And now we're seeing things looking quite tenuous. And I think Bitcoin crypto assets are participating in that. But Andrew, there's something else that's going on in the crypto space specifically that seems to be throwing fuel on the fire here for this general risk off trade. Why don't we talk about what's going on?
Yeah, so the big news is around Celsius, which is a custodial lending platform. So essentially, people kind of call it a CDFI because essentially what it does is users deposit crypto assets onto Celsius. They then custody those assets for the users and take them out and essentially deploy them into different DeFi yielding opportunities. Almost acting kind of like a bank in a way, like a crypto bank. And then essentially taking the spread between the yield they pay to users and the yield that they actually earn. And it grew massively. At one point, I think it was a $10 billion market cap with $24 billion of AUM, and had like huge Canadian pension funds putting hundreds of millions of dollars into their VC rounds. So like very relatively reputable, but they've been very aggressive on growth, on subsidizing growth with their token, and obviously they've done a good job. But there's been kind of rumors swirling on crypto Twitter for about a month now that they essentially took a hit during the Terra Luna collapse. Celsius was actually rumored as one of the entities potentially sort of going to step in to bail out Terra. So I'm not sure if they actually did have exposure, if that was just kind of a rumor swirling around, given that they were kind of coming in to bail out Terra. And so there's been kind of like an undercurrent of rumors swirling around, and then essentially what happened is because of these rumors, people started pulling out assets from Celsius just because kind of fearing a bank run situation, which in reality ended up actually creating a bank run to a certain extent, where people have been pulling out assets. And the way Celsius works, one of their biggest sort of positions is staked ETH. So essentially they take Ether and then they stake it and they earn, I think it's about a 5%, 6% yield. But the problem is they can't get yield. They can't get that Ether is locked up permanently, or at least until the sort of the merge is done. And so what that means is that there's a liquidity mismatch there. And what's happened over the last little bit is, as people have been worried about this liquidity mismatch, people have been selling down the staked Ether token. And so now there's about a 7% discount between staked ETH and ETH. And that's a big issue because if I'm someone that put an ETH into Celsius and I want my capital back, essentially Celsius is forced to sell at a discount to actually get people's ETH back. And so given sort of the rumors and given that situation, and obviously just the crypto market itself is tanked over the last week, Ether's down about 35%. They were forced to gate withdrawals Sunday night, sending an email to everyone. And then, which actually in a lot of ways makes sense. It's the best way to sort of responsibly solve this liquidity crisis rather than just having it be a free-for-all type bank run situation. But that's obviously led to even more panic because now people can't get their assets out, and a lot of people are worried about, there's not a huge amount of transparency, at least yet, on terms of what they actually have. So yeah, anyways, it's been a crazy situation. compounded by just the overall destruction in crypto market prices. I don't know, like, have you been following the situation, Alex? I don't know if I'm sure you're on crypto Twitter, so I'm curious what your thoughts are on this.
Yeah, definitely. I mean, I think it's interesting because it's CDFI in a couple of ways, because number one, you actually know the wallet addresses for Celsius, right? So you can actually see, like, collateral, what they have, what are those assets, how they're being drawn down, et cetera. But also it's a private business, so you actually don't know everything that's going on inside of the company. So we can only guess based on what's available in the public markets. It's likely actually that the company is in fine shape and that it's dealing with a panic effectively. And bank panics used to happen all the time back in the old days, before the introduction of federal insurance on depositor accounts and before the invention of the Federal Reserve Bank in the US. So it might sound like I'm arguing for some central authority to help calm people's nerves. I'm not necessarily. I'm just simply pointing out that these kinds of things, these runs on banks, did occur back in the old days more frequently. And funnily enough, a run on a bank can turn a healthy bank into a sick bank and into a dead bank, just based on the fact that people want instant liquidity. I mean, if there was a run on a bank like RBC or JP Morgan or something, and every single depositor actually wanted to withdraw every single dollar, the bank would be unable to meet those withdrawal requests, because all of the money that those depositors put in the bank have now been lent out to people who have mortgages and home loans, and to businesses that are building office towers that take 10 years to pay back. You can't just like instantly turn those assets into cash. And so I think the decision to gate withdrawals and to manage the situation the way they're doing is the right way. Frankly, it's the only way, because honestly, if they'd kept going at the prior rate, I do think they would have been unable to meet redemptions if people had continued to go requesting them. So we'll see how this all plays out. I think, frankly, like, we're in this situation where rumors are swirling around the industry about various kinds of blowups and other issues that might be happening. It is the peak of fear and uncertainty in the markets. This is true not just in crypto, but in all risk assets. And so I think that the fact they've decided to gate this is maybe the right thing for Celsius, but for the market, I think has corroded trust even further, right? I think, to your point. And so I'm not sure exactly how it plays out. If in fact the company's able to shore up its reserves and open its redemption, or to ungate and to begin redeeming successfully and without incident, then all of a sudden maybe that's a sign of a company can pause and reflect and get the thing done, right? So I'm not sure. We'll see how it plays out.
Yeah, and one thing to note, actually, the Celsius token, which essentially quasi serves as a backstop for the whole platform, has been in sort of a 6-month decline, kind of similar to the overall crypto market. But today it's actually up 81%. At one point it was up 350% on the day. So I think there's a lot of the Celsius token right now is sort of being priced. It kind of reminds me of like one of those like a bankruptcy stock, like a stock that with tons and tons of debt, where you don't know if it's actually going to go bankrupt or not, and if it doesn't, then the equity is dramatically undervalued. And so it's sort of trading like a highly distressed asset at the moment, with huge volatility. Yeah, I'm just looking at the chart right now. It's up 71% today, and at 56 cents, and at the peak of the day it was actually at $1.50.
Really?
After starting the day at 25 cents. You gotta love crypto.
Yeah, we'll see. But one other thing too, which is worth mentioning, is that Celsius is a company that was started by this outspoken entrepreneur, Alex Mashinsky, whose style on Twitter, I think like a lot of crypto entrepreneurs, has tons of devotees and followers, and then lots of people who he rubs the wrong way. But since the fall of last year, when they took in the big investment from the Case de Depot here in Canada, they've really upgraded their management team with professional management team. Their CFO, his name's Rod Bolger. He's the former CFO of RBC, which is one of the 10 biggest banks in the world. And he's someone who, I mean, not knowing what's going on inside of the company, has said publicly in interviews and so forth that improving internal controls and improving systems and managing risk is a big priority of his. So he's only been in the job for 5 months, so hopefully he's had enough time to do that. But I think that we shouldn't jump to. I think there's an assumption in crypto. You got to jump to conclusions that it's either going to go to the moon or it's going to crash, right? And maybe this is actually a situation where it takes a few months and it's not particularly sexy, but the company works out its issues and ends up fine on the other end.
Yeah, totally. I think there was obviously a huge panic on Sunday night, and it was also just compounded by the overall crypto market absolutely nuking over the last week to the downside.
Yeah.
So I could actually easily see the situation kind of just like quietly resolving. I could definitely see that. A lot of people were sort of there's sort of two ways that Celsius can be kind of considered insolvent, which I don't even think is really the right way to think about it. But there's one where it's essentially a balance sheet insolvency, where in that case, they just simply don't have enough assets to cover all of the sort of liabilities, which would be a huge disaster if that's the case. Kind of similar to like the Terra situation. I don't actually think that's the case. And then there's the second sort of insolvency, you can call it, which is really just a liquidity mismatch, which can actually be solved for. It'll take some work, and they may have to take a bit of a haircut, but it doesn't actually necessarily mean, and also people may have to wait for their assets, but it actually doesn't mean that the whole thing's going under. It's tough to know really which is which. I would guess it's the second one. It's kind of this isn't the sort of insane like blow up of value that we saw with Terra. So I think this is more just they have a ton of their assets locked up in staked ETH, which is earning a yield, but currently is trading at a discount, and which to a certain extent might not make sense, to be honest with you. But
yeah.
So anyways, I just think the market needs liquidity right now, and so because of that, illiquid stuff like staked ETH is trading at a discount, which obviously disproportionately hurts lending platforms like Celsius that are obviously essentially like hold more liquid assets than they actually can sort of fulfill.
Well, the staked ETH part of this is really interesting, right? I mean, you've got the situation where in order to generate yield on ETH, you can lend it out, right? You can put it into DeFi pools. But one of the things they did is they basically staked it to the beacon chain, which generates a yield, but is locked up until the merge actually happens. And so it's like taking in money in a bank and then lending it out to a project that's not going to have its first payout in years from now, right? And it's like if you want to liquidate that position, it's going to take a really long time. And so, it's again one of these things where maybe it was the asset selection process that put them in a position where they've got some too liquid assets that are too liquid on their books, basically. And staked ETH is in a way a form of sort of a liquid asset. Anyway, so the whole thing is very fascinating. When we were talking about the whole Luna situation, I was pretty convinced that there was no contagion element really of what had happened. I mean, and the proof was in the pudding. Like Luna was an unmitigated disaster. It was a collapse UST, and people lost a lot of money and so forth. Not to diminish that, but it seemed at the time, at least, that there was no bailout, there was no bail-in, and there was no kind of contagion beyond that, other than the general sort of malaise in crypto prices, right? So things went down, but everything was going down, and still is. So, am I wrong about that? Like, was there some connection here where there's a thread between Luna and Celsius? And from here, I guess, will there be a knock-on effect? Like, is there another domino to fall? Even if Celsius doesn't fall and it rights the ship, like, is there something here that could start to spread into other parts of the market?
Yeah, I think there's three core projects or even sort of funds to look at as the next potential blow-up risk. I think these are more sort of remote. So the first is Nexo, which is another sort of Celsius-style lending platform. They, from what I can gather, I don't use Nexo, but they typically have a more sort of transparent form of sort of showing their assets and attestation. So, but there was a lot of fear right after the Celsius gating withdrawals that Nexo would be next. I saw a ton of stuff about that. Nexo kind of sort of, I don't know if it was a joke or not, they put out on Twitter an LOI to acquire all of Celsius's assets. They like publicly open sourced an LOI to buy Celsius with no price in the LOI. I don't know if that was just kind of a joke from a competitor, but a lot of people were kind of commenting that they would likely be the next one to fall. I don't know if that's true though. The second one, which seems more obvious, is Tron. So Tron has launched their own Terra-like stablecoin called USDD. And essentially it's similar to Terra. It's mostly backed by Tron. So it's essentially collateralized with Tron itself. And it has a much higher collateralization ratio, though, I should say. It's around, I think, 65, 70% versus, I guess, 20% or 15% for Terra. But obviously, given Tron, the whole crypto market going down, people are starting to test that as well. It's still at a small enough level that it hasn't become sort of a huge issue, but it's definitely something a lot of people have talked about. Another one that's lesser is something like Waves. And then the third one, which is probably the most speculative by far. Again, these are all just sort of stuff I'm picking up on crypto Twitter, though I will say crypto Twitter was very early on pointing to signs about Celsius, so I have to give it some predictive power. But the third one is Three Arrows Capital. So there's a lot of rumors right now, mostly like all anonymous sources, saying that Three Arrows is being margin called. These are quite speculative rumors, but they were known to have a huge position in Terra. The sort of co-founders of Three Arrows literally had the ticker of Luna in their bio. And so it's sort of, that's a rumor flying around, and they've also sort of stopped tweeting and stopped being public over the last 2 weeks. So, I mean, I don't know, that would be a huge, they're over $1 billion in AUM. That would be a huge sort of domino. And if they were sort of liquidating assets to meet margin calls, that would also make sense why we're seeing such sort of massive forced selling in the market that we were seeing. Though this is just things I'm picking up on crypto Twitter. But yeah, I think one of the things that's sort of just caveat all the stuff I'm saying with what's interesting is I thought I would see a lot more dominoes to fall after Terra blew up. And maybe it's a situation where it just kind of takes a month to show up, but sort of surprised that there hasn't been anything, no real huge projects have collapsed because of Terra's collapse, at least yet. So I don't know, like, what have you seen anything? Like, I haven't seen any sort of systematic like forced unwindings. It's all been sort of slow over the last month, and a lot of rumors. Celsius being the only rumor that I've seen actually come true.
Yeah. Yeah, I have no idea. I mean, I've heard the same kinds of rumors, so I guess we'll just have to wait and see. I do think, though, that, if you look at the market where it's at today, the price of Bitcoin, the value of some of these other protocols, they're trading at levels that I think people have to start paying attention. I mean, Bitcoin is a hair away from its 2017 local high, right? So that's from the last cycle. And if you look at all prior cycles, that's generally, a pretty good time to start paying attention. If you look at the market capitalization of Ethereum, it's only marginally higher than the market capitalization of stablecoins, many of which sort of trade on Ethereum. So that's sort of a sign that, you've got a product on the network that is almost as big as the network's market value, which to me suggests that the underlying network is undervalued, right? You've got these alt layer ones that we've talked about a lot on the show, and the DeFi protocols and projects that are built on top of that have been absolutely hammered. Those I'm a little less sure about, because the big value proposition for the L2, the new L1s, was that Ethereum's too congested and gas fees are too high, and as a result, you got to look to these other L2s. Well, what if we're in a situation where the next 6 months the following two things happen? We stay in a bear market, and overall network activity declines or remains flat, and the merge happens. all of a sudden you've got like the main network moving to proof of stake, probably reducing overall gas fees, driving interest to Ethereum because the supply is deflationary, and there not being as much of a need for those alt layer ones as platforms to run applications and do stuff, right? I mean, it's almost, we talked about previously how the whole idea of like block space as being a scarce resource, and that's true. But in a bear market, maybe that gets just pushed out a year or two because actually, there's enough block space to go around. Now, I don't know. What do you think of that theory? You're muted, Andrew.
Sorry, yeah. I think so I've seen that argument a lot. What's interesting is I actually wrote an article about this called Principles of Macro Crypto Economics. And essentially there's this, what we've seen historically is there's this relationship where when things get really heated, block space becomes really expensive, which then naturally puts a damper on activity because things just become far too expensive. And then you see the sort of inverse. So when prices go down quite a bit, it's actually more attractive to use the network versus just not using the network. So if you think about it like an economy, when block space becomes really cheap, it's almost like a massive stimulus plan, or like it's like the equivalent of like cutting taxes by 95%. And so at least what I've seen historically, it's actually that tends to be the best time to actually use the network, which then naturally leads to more development, which then sets up the next upcycle. So it's kind of like how that, I'm not sure exactly what the relationship is, but there's this relationship in energy where if energy prices go down, people just end up using more energy, which sort of, I have to find the exact relationship, one sec. Well, anyways, moral of the story though is I think like, if you think of Ethereum like an economy, the less expensive that block space is, it's like a big stimulus program, essentially injected into the Ether economy. With that being said, I still think on a sort of multi-year horizon, block space on Ethereum is going to get dramatically more expensive to the point where no end users use Ethereum mainnet. Like in 20 years, people will think it's hilarious that you could send someone like $5 on Ethereum mainnet because the cost of using Ethereum mainnet are sort of $5,000 to $10,000 per transaction. And the only people who use Ethereum mainnet are people who are willing to spend, who are incredibly price insensitive. So that'd be like use cases like Polygon POS, which literally settles their entire chain using the Ethereum mainnet. They're completely willing to spend $5,000 to $10,000 to do so. Whereas someone just using a lending platform, unless it's like a sort of a 7-figure plus transaction, they're not going to use the Ethereum mainnet. It's just too insane. So I think that's fine. I think another thing too, one last thing, the crypto market itself, the best time to invest and build projects in crypto is during bear markets, because no one cares about crypto during those periods. And so you can build this kind of incredible defensive position when no one's looking at the market. And then when the bull market comes, you're already set up to sort of reap the rewards. So I actually get weirdly excited about bear markets because it just gives us more time to build on the SX side.
Yeah, well, let's maybe wrap it up on that one. So I noticed SX Network is now up to 500 different prediction markets and just cleared $185 million of total, transaction value. Seems like a big milestone to hit in the midst of what is otherwise a pretty cruddy time in the markets. So what are you seeing on your end?
Yeah, I think it's really interesting because so on the prediction market side, we're obviously still impacted somewhat by the crypto market, though I would say relative to other use cases, it's relatively, I guess, non-cyclical. Whereas DeFi is highly cyclical. So what you're seeing right now is a lot of DeFi platforms are actually growing in the number of tokens that are coming to them, but their TVL and dollar amounts is actually going down dramatically because the TVL is denominated in dollars, and if you're adding twice as many tokens to your platform, but the price of those tokens is down 95%, then you're going to go down.
Yeah.
So for us, we've been relatively insulated, at least relative to other projects. I think now is the perfect time if you're running a crypto project that actually makes money. So historically in the stock market, value stocks outperform during bear markets and growth stocks outperform during bull markets. And I think the exact same thing is going to happen in the crypto market. There's sort of a flight to quality and things that actually generate cash flow. And so I think anyone that's building in the space should completely prioritize revenue and sort of maximizing protocol value capture versus just sheer growth, which comes at the cost of token subsidies, which are then promptly dumped on the market and sort of collapse the whole thing. So we're seeing a sort of vicious snapback to fundamentals in the overall crypto space, which I think is going to leave a lot of non-fundamentally sound DeFi projects sort of just permanently dead. So yeah, I think it's in a way it's kind of good.
Yeah, maybe a clearing of the deck for other things to, emerge and create value in the space. We'll see. I don't know. It's an interesting time. I'm with you on the bear markets. I mean, it's during the bear markets the last time around when the DeFi summer happened, when NFTs happened, when, USDC was launched, when these new L1s were created, when we saw prediction markets like SX launch. I mean, all of this stuff kind of got its start in the last cycle. So every cycle brings bigger and greater innovation, and I think a bigger and greater impact in the world. I'm excited to see what happens. I'm not prepared to say that we're in a crypto winter. I think people have been quick to rush to that conclusion. I think there's something that distinguishes this from the past, which is, the organizations are far more sophisticated. There's way more depth of talent, and there's way more funding. There's billions of dollars on the sidelines still that's looking to deploy into this asset class, and not just into large cap crypto assets, but rather directly into the venture capital opportunities. So I think that, we're in a period generally where cycles, and whether they're economic cycles or market cycles, generally tend to happen at faster and faster clips. It took 20 years for the Dow Jones to make it back to its 1929 high right after the crash. And, in 2020, it took 3 months. And so we'll see how this sort of cycle plays out. But I do think that there's a lot of capital chasing the space, and there's a lot of innovation that's happening. So I think it's going to be a really productive time, as you said.
Yeah, I don't think it'll take 20 years. The one thing I will say, if we are going into like a multi-year bear market, I will say I'm a bit surprised. I thought ETH would have gone way higher, would have topped out at a much higher price. I was thinking it would probably hit 10K in this cycle, and that's where we would top out. So, I mean, obviously it's hard to predict the crypto market. I think one thing, if you look at the past, crypto tends to bottom out at the prior cycle's highs. So we saw that in 2017 where Bitcoin hit 21,000 and then sort of bottomed out around 3,000. And the prior cycle was 2013 and it had hit about 1,200. So it bottomed out about 2x the previous cycle's highs. Right now we're actually at the 2017 highs, essentially. Bitcoin's pretty close to, I think, let me just check real quick. Bitcoin is essentially at the 2017 high right now at 22,000, and ETH is actually below the 2017 high. So if you had bought at this high of 2017, you're actually down on ETH, which seems crazy to me because ETH from 4 years ago, or I should say 5 years ago, is a totally different asset than it is now. Yeah. There's like a multi-$100 billion DeFi market. There's hundreds of millions of dollars in NFTs that are traded every day across multiple different NFT platforms. And there's just like tens of thousands of apps. So to me, it just seems like a bargain, but I know there's a lot of things in this space right now that seem like sort of like nonsensical bargains. Yeah. But obviously the macro environment's changed, so it's tough to know exactly. But like I am seeing some projects trade at less than 1x earnings. Obviously earnings are going to go down next year, but that still seems a bit crazy to me.
When you say one times earnings, I know where we want to wrap this up, but what do you mean exactly? Like what is an earnings? What are earnings on a protocol?
Yeah, so I mean, this is a common trap, to be honest with you, when you're valuing DeFi platforms, because their revenue is so cyclical. So sorry, and to answer your question, it's essentially the amount of value that is generated from a protocol that actually goes directly to the token. That's how I sort of measure protocol revenue.
Okay.
And that can either be directed to a treasury, which token holders have control over, or it can actually be used to buy back the token or sort of distributed through staking rewards. And there's some platforms right now that are paying staking yields excess of 50% on actual earnings. I've seen a couple of DeFi projects that trade at like less than a $5 million market cap that are doing hundreds of thousands of dollars a month in revenue, or at least have over the last 12 months. The market is essentially projecting that their revenue is going to decline drastically with a slowdown in the overall market. But if we actually do go back to where we were, then they're kind of crazily undervalued, because they could just buy back all of their tokens in a year if they were to do buyback. So yeah, I mean, I'm seeing a lot of bargains in the DeFi space, definitely.
Yeah, absolutely.
But it's tough to know whether that's just the market essentially pulling forward future revenue declines. So it's tough.
Well, that's the case with anything. It's like Coinbase today trades at 3 times its earnings on a trailing basis, but maybe an infinite number on its forward earnings because it's probably going to lose money, right? It's hard to predict where the future goes. All right, Andrew, great chat as always. I think we'll probably have a guest next week. Maybe if we're still in the dumps here, we'll have someone who can help us navigate it. But as always, I love these kind of chats where we get to go through the market and pick your brain on what's going on. So thanks, Andrew. And we'll see everyone next week on another episode of DeFi Decoded. Be well. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.